Resolution Trust Corporation. The Resolution Trust Corporation (RTC) was a U.S. government-owned asset management company run by Lewis William Seidman and charged with liquidating assets, primarily real estate-related assets such as mortgage loans, that had been assets of savings and loan associations S&Ls declared insolvent by the Office of Thrift Supervision (OTS) as a consequence. It also took over the insurance functions of the former Federal Home Loan Bank Board (FHLBB). Between 1989 and mid-1995, the Resolution Trust Corporation closed or otherwise resolved 747 thrifts with total assets of $394 billion. Its funding was provided by the Resolution Funding Corporation (REFCORP), which still exists to support the debt obligations it created for these functions. History. The Resolution Trust Corporation was established in 1989 by the Financial Institutions Reform, Recovery, and Enforcement Act (FHRIA), and it was overhauled in 1991. In addition to privatizing and maximizing the recovery from the disposition of the assets of failed S&Ls, FHRIA also included 3 specific goals designed to channel the resources of the RTC toward particular societal groups. The goals included maximizing opportunities for minority and women-owned contractors, maximizing availability of affordable single and multifamily housing, and protecting local real estate and financial markets from asset dumping. Of the 3 goals, only the protection of local markets and concerns over dumping was given a great deal of attention. The agency was slow to implement minority and women-owned business MWOB and affordable housing programs. The Resolution Trust Corporation was a 501(c) organization. In 1995, the Resolution Trust Corporation's duties were transferred to the Savings Association Insurance Fund. In 2006, the SAFE and its sister fund for banks, the Bank Insurance Fund (BIF), also administered by the FDIC, were combined to form the Deposit Insurance Fund (DIF) under the provisions of the Federal Deposit Insurance Reform Act of 2005. Equity partnership. After initially emphasizing individual and bulk asset sales, the Resolution Trust Corporation pioneered the use of equity partnerships to help liquidate real estate and financial assets inherited from insolvent thrift institutions. While a number of different structures were used, all of the equity partnerships involved a private sector partner acquiring a partial interest in a pool of assets, controlling the management and sale of the assets in the pool, and making distributions to the RTC based on the RTC retained interest. The equity partnerships allowed the RTC to participate in any gains from the portfolios. Prior to introducing the equity partnership program, the RTC had engaged in outright individual and bulk sales of its asset portfolios. The pricing on certain types of assets often proved to be disappointing because the purchasers discounted heavily for unknowns regarding the assets, and to reflect uncertainty at the time regarding the real estate market. By retaining an interest in asset portfolios, the RTC was able to participate in the extremely strong returns being realized by portfolio investors. Additionally, the equity partnerships enabled the RTC to benefit by the management and liquidation efforts of their private sector partners, and the structure helped assure an alignment of incentives superior to that which typically exists in a principal/contractor relationship. The following is a summary description of RTC equity partnership programs. Multiple Investor Fund. Under the Multiple Investor Funds MIF program, the RTC established limited partnerships, each known as a multiple investor fund, and selected private sector entities to be the general partner of each MIF. The RTC conveyed to the MIF a portfolio of assets, principally commercial non- and sub-performing mortgage loans, which were described generically, but which had not been identified at the time the MIF general partners were selected. The assets were delivered in separate pools over time, and there were separate closings for each pool. The selected general partner paid the RTC for its partnership interest in the assets. The price was determined by the derived investment value (DIV) of the assets, an estimate of the liquidation value of assets based on a valuation formula developed by the RTC, multiplied by a percentage of DIV based on the bid of the selected general partner. The general partner paid its equity share relating to each pool at the closing on the pool. The RTC retained a limited partnership interest in the MIF. The MIF asset portfolio was leveraged by RTC-provided seller financing. The RTC offered up to 75% seller financing, and one element of the bid was the amount of seller financing required by the bidder. Because of the leverage, the amount required to be paid by the MIF general partner on account of its interest was less than it would have been if the MIF had been an all-equity transaction. The MIF general partner, on behalf of the MIF, engaged an asset manager, one or more entities of the MIF general partner team, to manage and liquidate the asset pool. The asset manager was paid a servicing fee out of MIF funds and used MIF funds to improve. The asset manager was responsible for day-to-day management of the MIF, but the general partner controlled major budgetary and liquidation decisions. The RTC had no management role. After repayment of the RTC seller financing debt, net cash flow was divided between the RTC as limited partner and general partner in accordance with their respective percentage interests. The general partner had at least a 50% interest. Each of the MIF general partners was a joint venture among an asset manager with experience in managing and liquidating distressed real estate assets and a capital source. There were 2 MIF transactions involving more than 1,000 loans having an aggregate book value of slightly over $2 billion and an aggregate DIV of $982 million. Mortgage trusts. N-Series. S-Series. The S-Series program was similar to the N-Series program and contained the same profile of assets as the N-Series transactions. The S-Series was designed to appeal to investors who might lack the resources necessary to undertake an N-Series transaction and differed from the N-Series program in the following respects. The S-Series portfolios were smaller. The S of S-Series stands for small. The average S-Series portfolio had a book value of $113 million and a DIV of $52 million, whereas the N-Series average portfolio had a book value of $464 million and a DIV of $220 million. As a consequence, it required an equity investment of $4 to $9 million for investor to undertake an S-Series transaction versus $30 to $70 million for an N-Series transaction. The S-Series portfolio was not leveraged through the issuance of CMBS, although it was leveraged through a 60% RTC purchase money financing. In the N-Series program where CMBS were issued, the asset managers had to be qualified by debt rating agencies, e.g., Standard and Poor's, as a condition to the agencies giving a rating to the CMBS. This was not necessary in the S-Series program. Assets in the S-Series portfolios were grouped geographically so as to reduce the investor's due diligence costs. There were 9 S-Series transactions, into which the RTC contributed more than 1,100 loans having a total book value of approximately $1 billion and a DIV of $466 million. The RTC purchase money loans, aggregating $284 million for the 9 S transactions, were all paid off within 22 months of the respective transaction closing dates. On average, the purchase money loans were retired in 16 months. Land Fund. The RTC Land Fund program was created to enable the RTC to share in the profit from longer-term recovery and development of land. Under the Land Fund program, the RTC selected private sector entities to be the general partners of 30-year. The Land Fund program was different from the MIF and N/S series programs in that the Land Fund general partner had the authority to engage in long-term development, whereas the MIF and N/S series trusts were focused on asset liquidation. The RTC conveyed to the Land Fund certain pre-identified land parcels and non/subperforming mortgage loans secured by land parcels. The selected general partner paid the RTC for its general partnership interest in the land fund. The winning bid for each land fund pool would determine the implied value of the pool, and the winning bidder, at closing, would pay to the RTC 25% of the implied value. The land fund investors were given the option of contributing 25%, 30%, 35%, or 40% of the equity for commensurate interest, but all chose to contribute 25% of the equity. The land fund general partner could, at its discretion, transfer assets in land fund pools to special purpose entities, and those entities could then borrow money collateralized by the asset to fund development. Furthermore, a third-party developer or financing source could acquire an equity interest in the special purpose entity in exchange for services or funding. The general partner was authorized to develop the land parcels on a long-term basis and had comprehensive authority concerning the operation of the land fund. Costs to improve, manage, and liquidate the assets were borne by the land fund. Net cash flow from the land fund was distributable in proportion to the respective contributions of the general partner 25% and RTC 75%. If and when the land fund partnership distributed to the RTC an amount equal to the RTC capital investment, i.e. 75% of the implied value of the land fund pool, from and after such point, net cash flow would be divided on a 50/50 basis. Land fund general partners were joint ventures between asset managers, developers, and capital sources. There were 3 land fund programs, giving rise to 12 land fund partnerships for different land asset portfolios. These funds received 815 assets with a total book value of $2 billion and DIV of $614 million. Judgments, deficiencies, and charge-offs JDC program. Under the Judgments, Deficiencies, and Charge-offs Program JDC, the RTC established limited partnerships and selected private sector entities to be the general partner of each JDC partnership. The JDC program was different from the MIF and /S series and land fund programs in that the general partner paid only a nominal price for the assets and was selected on a beauty contest basis, and the general partner rather than the partnership itself had to absorb most operating costs. The RTC would convey to the limited partnership certain judgments, deficiency actions, and charged off indebtedness JDC and other claims which typically were unsecured and considered of questionable value. The assets were not identified in advance and were transferred to the JDC partnership in a series of conveyances over time. The general partner was selected purely on the basis of perceived competence. It made payments to the RTC in the amount of 1 basis point 0.1% of the book value of the assets conveyed. The general partner exercised comprehensive control in managing and resolving the assets. Proceeds typically were split 50/50 with the RTC. Operating costs, except under special circumstances, were absorbed by the general partner, not the JDC partnership. JDC general partners consisted of asset managers and collection firms. The JDC program was adopted by the FDIC and is still in existence.